The first way you can reduce your taxes on incentive stock options is when you exercise. And if the stock value drops, when you exercise while the stock is down, that means less spread that is being subject to taxes. Exercising while the stock is down could reduce or completely remove both AMT and the ordinary income tax. If you're at a private company, there obviously isn't going to be as much volatility as if it were a public company. That being said, even at private companies, if the stock price drops enough, oftentimes those companies will completely reissue grants at a new and reduced strike price in order to retain the employees. Then oftentimes you don't pay any tax when you exercise.
Another great way to save taxes on your incentive stock options is through something called AMT Crossover, which I'll show you right here. And how the tax code works is that when you calculate your tax liability, there are two equations at play. You've got the regular tax equation, and then you've got the alternative minimum tax equation. And you don't actually trigger an alternative minimum tax liability until this bar exceeds whatever the regular tax portion is. So you essentially have all of this space right here to recognize or exercise more incentive stock options without actually triggering the alternative minimum tax. So this is an awesome tax planning opportunity to essentially earn income without it being taxed.
This next form of saving taxes on incentive stock options is something that I like to call AMT rate stealing. So when you have both tax rates at play, your net tax bill has both the alternative minimum tax portion and a regular tax portion. And if your regular tax rate is in the highest 37% income tax bracket, while the AMT is in the 28% tax bracket, this creates an opportunity for you to save on your net tax rate. So if you think about it, rather than exercising incentive stock options, triggering more AMT and creating this number to be much larger, you can come over to the regular tax portion and do something like an NSO exercise if that's available to you, or Roth conversions that boost this number up. And the cool thing about this is that while this is still growing at 37% and this is growing at 28%, the net tax rate or the net tax impact was just at 28%, not your ordinary income's 37% tax rate. Here's a quick analogy to help you understand that a little bit better. Imagine two cars in a race. This car right here is traveling 37 miles per hour to represent the 37% tax bracket, while this car is in the lead, traveling 28 miles per hour to represent AMT's 28% tax bracket. If you give each of these cars an hour to drive, this one will have driven 37 miles, whereas this one will have only had driven 28 miles. So the distance between these two cars is shrinking. And looking at the net tax impact, while this green amount will have jumped by 37 miles or by 37%, and AMT will also have grown by an additional 28% or driven 28 miles, the spread between these two cars is actually shrinking. Even though the amount of AMT shrunk and the amount of regular tax grew, the net tax impact was only 28%. If you had earned that just in the regular tax amount, that would have been an increase of 37%, but because you utilized AMT, the net tax bill only increased by 28%. This is why I like to call it stealing the AMT rate. So this is how you save taxes through this strategy. Let me show you another way to save on taxes. This next tax saving technique doesn't actually apply to incentive stock options, but it does apply to the alternative minimum tax, which sometimes goes hand in hand with the incentive stock option. So how this works is if you have the ability to exercise before shares are vested, also known as early exercising, then you can lock in the bargain element, which is that spread between the exercise price and the fair market value on the date of exercise, and that spread gets added to the AMT calculation. So if you lock that up, then you are essentially going to save on taxes if there's subsequent appreciation after filing that 83B election. Now, there are a few things that you have to be aware of. One is if you can actually do it, which again, you have to have the ability to exercise before shares are vested, which you can find that out in your plan documents on if early exercising is a possibility. Second, it doesn't always make sense to do that, especially if you're going to be doing some sort of disqualifying disposition where you're selling your incentive stock before the end of the tax year.
Another great way to reduce the taxes on your incentive stock options is just through general tax planning. Let me show you exactly how that works. So we live in a progressive tax system here in the United States, which means that the more income that you earn, the higher tax rate that you're going to pay. And so if you are earning more income that forces you from one step to the next step, it just means that that next dollar will be taxed at that higher rate. It doesn't mean that all subsequent income up to that point is being taxed at that higher rate. It just means that next dollar. And that's what we mean when we refer to the marginal tax rate. And so when it comes to tax planning here, your income, represented by this line, could fall right there on the edge of that step. And so through strategic tax planning, we could shift your income to a lower step. And that does a couple of things. It means there's less tax liability in the first place, but we could even take it one step further and say, okay, there is an opportunity to recognize more income at this lower rate. So that right there is a tax saving strategy. So what are some ways that you can reduce your income or shift this line to the left? You've got 401k contributions, because as you contribute to a 401k, it just means that less of your income is being reported to be taxed. Tax is deferred on 401k contributions, so you actually avoid paying taxes on it. You've got HSA contributions and, if applicable, deductible IRA contributions. You've got the standard deduction, and you've even got itemized deduction, which opens a whole new realm of planning opportunities to reduce your taxes.
This next planning opportunity is by far probably the best as far as the amount of tax savings that you can get from this. And it's kind of similar to the 83B election in that it can only be applicable in a few circumstances. And this is called qualified small business stock, also known as QSBS. And what that allows you to do is, if you exercise or purchase your shares before the net assets of a company exceed $50 million, then you can eventually sell those shares later at $10 million tax-free. And that is compliments of the federal government. Not all states will match that from a state income tax perspective. New York will honor that, whereas states like California won't honor that. That being said, the federal government has typically the larger tax rates, the highest being 37% on ordinary income taxes and 20% from a capital gains perspective. Everything that we've discussed up to this point has been dealing with saving taxes when you exercise your incentive stock options. But what about when you sell your incentive stock options? What are some opportunities there?
The next way to save on taxes when you sell your incentive stock options is actually the whole premise to incentive stock options. ISOs, or incentive stock options, were created to give employers and employees a tax benefit. So what is the tax benefit? Well, in order to receive it, you actually need to ensure that you don't sell unless it's been 2 years from the date of grant and 1 year from the date of exercise. And what that allows you to do is to have more of your gains subject to the more advantageous and better tax rates of long-term capital gains. And if you're jumping from the current highest tax rate of 37% of ordinary income down to the highest tax rate of capital gains at 20%, that's a 17% tax savings on your incentive stock option gain.
There are way more opportunities to save on taxes than just 7. So here's a few more. The very first strategy that we addressed was exercising while the stock is down, which doesn't actually allow you to write that as a loss off because you're not selling the stock, you're just purchasing it at a lower fair market value, something that's closer to the strike price. That being said, when you sell, you actually can write that loss off if you keep a few simple certain rules. This is known as tax loss harvesting, and the day that you sell your stock for a loss, just ensure that you keep these rules, otherwise you will not be able to write that loss off, and that is known as a wash sale. And so in order to avoid the wash sale rule, you cannot have purchased the stock 30 days before you sold for a loss, the day that you sold for a loss, or 30 days after you sold for a loss. And so that's a total of 61 days within which you cannot purchase shares. And this is where it gets a little more complex. So even though you might not be going to the market and purchasing your company's stock outright, there are a few more subtle ways that the federal government has yet to clarify on whether or not this is actually going to trigger a wash sale rule, but it's better to be safe than sorry. If you think about exercising a stock option, you're essentially purchasing company stock. So that's one way that you want to avoid triggering the wash sale rule, is not exercising within that 61-day window. And it gets even more complex if you have ESPPs, because the employee stock purchase plan has 2 purchase dates within the year that you are purchasing essentially company stock. And so you have to avoid purchase dates on the ESPP, you have to avoid exercising, and you want to ensure that your RSUs are not vesting during that 61-day window, because RSUs vesting is a day that you're essentially, again, purchasing stock. Even though it's not being purchased, it's something that may trigger that wash sale. So this type of complexity is why I started my wealth management firm, to specialize in helping people like this. And so please ensure that you are working with a professional, because this is not something that you want to take lightly. This video does not constitute individualized tax, legal, or investment advice.
Building on the idea of general tax planning, which is dealing with mostly the regular tax system, with incentive stock options, we're actually bringing a second tax system into play, which is the alternative minimum tax. Here's how to visualize it. These blue steps represent that regular tax portion that we were discussing and the tax planning opportunities available. When it comes to the second tax system at play, the AMT, there's only two tax rates that are mentioned on the AMT tax form 6251 in the whole code, and that is 26%, and then once you reach a certain income threshold, it jumps up to 28%. But there is a higher rate that it actually can get taxed at, which isn't mentioned in the code, but it actually works out when you do some calculations. So when the AMT was first created, it was essentially created for those high income earners that were trying to avoid paying taxes. And so in order to not trigger AMT for the average Joe, they gave everyone an AMT exclusion. They said, okay, we're going to take this AMT number, we're going to drop that by a certain amount of dollars. And what happens is as you earn more income or trigger more AMT, they're going to recognize that, hey, you are the person that we are looking for. You are the one that's earning that income that we want to tax. And so as you earn more income in AMT over here, you actually start to lose that AMT exemption that was originally given to you. This is known as the AMT Phaseout. So for every dollar of AMT that you trigger, we're going to take back a quarter of that exclusion. The way it works is that if you are earning income and essentially losing that exclusion, you're not being taxed at AMT's 28%. You're actually being taxed at a much higher rate. It's 35%, and that carries on for a way, and it actually drops and creates another tax planning opportunity known as the AMT sweet spot right there, where it drops back down to 28%. But this portion right here where AMT is being taxed at 35%, which again, it doesn't make a lot of sense, but I have a separate video where I walk through the actual calculation and show you how it's actually being taxed at 35%. This is actually very wide right here. So there's a lot of income that gets taxed at 35%. So if your income is currently sitting on this little plateau, this 35% tax rate for AMT, we can implement tax planning strategies such as selling your incentive stock options, which reduces your AMT, in order to shift your income off of that 35% tax rate or that 35% AMT phase out to reduce your tax liability.
The next way to save on taxes when you sell your stock is when you sell your incentive stock options, you get a negative AMT adjustment. So if you originally triggered AMT and you now have an AMT credit, when you sell, you get a negative AMT adjustment. That's essentially equivalent to the bargain element, which is the spread between the strike price and the fair market value on the date of exercise. You get a negative adjustment on AMT. So your AMT is reduced in the year that you sell your incentive stock options. And when you reduce incentive stock options, you create more room to either exercise more incentive stock options without triggering. So maybe you could do the AMT crossover, or it creates more space for you to potentially recoup more AMT credit. Another way that you can save on taxes with your incentive stock options is if your shares become worthless. Typically when you do tax loss harvesting, you're only able to take $3,000 worth of capital loss and use that to offset up to $3,000 worth of ordinary income. And with ordinary income being the highest tax rate, that's very valuable to write that income off. But you're only able to write off $3,000 worth of ordinary income, which is very limited. What Section 1244 allows you to do is it allows you to take the amount of loss that you're writing off and use that to offset ordinary income. So you're essentially being able to write off more than the $3,000 worth of losses that you were able to write off originally.
But trying to optimize for taxes is the dumbest thing that you can do. When learning about taxes, we then start to psychologically anchor all of our decision making to try and optimize for taxes. And there's an old saying out there, don't let the tax tail wag the dog. And in fact, I've created a whole financial decision framework that helps us understand how important taxes is in comparison to other things. And I've labeled it as the least most important thing. There's actually 3 things that are more important than this that I discuss in this video right here.